training with Callan. Brent is working with us. And Alina, Bartenia. We're going to do some training, so
Okay, awesome.
over to you all.
Great. Thanks for having us. We're kind of in a big room. Let me know if you can't hear me. I handed out presentations. Richard, did I miss you? No, a different one.
Yeah, advisory note. Yeah, thank you.
Did anyone else missing the presentation? Might be easier to look at instead of the actual screens here. Great. So when we were talking about what sort of educational session we could bring to you, we thought of a few things, and we came up with talking to you about what it is to be a fiduciary very briefly. I know you've already done a lot of work on that. And then after that, we thought we would talk about asset allocation in general, because one of the projects you're going to be embarking on the first half of this year is to do a new asset allocation study. To understand all the details of the asset allocation study, we put together some basic information on capital market theory. Because asset allocation study relies heavily on a lot of terms, a lot of concepts that you learn in capital market theory. So that explains the outline that we have for you today. Talk about the role of the fiduciary with capital market theory, and then finally asset allocation. And in that part, we'll tell you how we're going to walk through and do an actual asset allocation project with you in the first several months of this calendar year. Talking about what it is to be a fiduciary, what I thought we'd first spend a minute on is talk about what the general fiduciary process is. So no matter what sort of investor you are, a personal investor, an endowment, a foundation, a corporation, or a public pension fund, all of these investors generally follow the same fiduciary process. And we have that outlined here on page 3. The first step of the fiduciary process is to analyze your current position, determine and document what sort of plan you are, what are your objectives, what are your limiting factors around you, what's your funded status, what's your contribution policy, analyzing your current position to formalize and say, okay, where am I, what am I trying to do, and where am I trying to go? Okay. The next step is to design an optimal portfolio. And we're going to be spending a lot of time talking about that today, what an optimal portfolio is, what do we mean by that. But in this, we determined, okay, what's an efficient mix of asset classes for you to put together to meet your objectives over the long run. The step after that is to formalize the investment policy that is the outcome of this asset allocation work. And so you write an investment policy statement that tells the world your beliefs, what your asset allocation should be, and how you are going to implement along the way. So this investment policy statement is a real important document. You have one, and we review it with you on a periodic basis. The next step is to actually go out and implement it. Okay? And when you go out and implement the investment policy, it generally means you're going out and you're hiring third parties to help you along the way. So this is where you go out and hire investment managers, the mutual fund managers in your retirement plan. You hire custodians. You recently brought one on board. And you take on things like securities lending if it was applicable to you, which it isn't in your investment program. And the final step is the one that you actually do most of the time when we meet, and that's monitoring and supervising. Monitoring and supervising, you take a look at what's happening in the capital markets. Has our asset allocation done what we thought it would do? Monitoring performance of investment managers along the way. And you use the performance monitoring and evaluation time period as a feedback loop back into how you come up with your long-term strategic asset allocation. A lot of this stuff that we talk about up front, analyzing current position, designing optimal portfolio, this is generally something you only do about every 3 to 5 years. Right? You come up with long-term strategic plans, and then you implement them. And then you monitor and supervise along the way, and then every 3 to 5 years, or if your situation changes, you go back and do a more formal stuff. So this is the full fiduciary process, and again, it applies to you and for any investment program that you would ever oversee. And today we're going to be talking a lot about the first 2 steps of this process, because again, you're going to be doing an asset allocation study in the first part of this year with us. So let's move ahead to page 4. And we'll spend just a few minutes talking about what it is to be a fiduciary. And we put together this information as an educational framework that we share with a lot of clients. And the law that was passed that applies to most clients and is often used as a benchmark for other clients that aren't subject to it is something called ERISA. It's the Employee Retirement Income Securities Act of 1974. And that is a law that governs specifically corporate pension funds. Technically it doesn't govern what you do here, but it's often held up as the best standard out there, the gold standard, if you will, about defining what it is to be a fiduciary and what the requirements are for your fiduciary duty. And outlined in that law, there are a few things that define, okay, who is a fiduciary, and what are the couple of the litmus tests to determine whether you are a fiduciary. And they are if you have discretionary control over the plan's management, if you render investment advice for a fee, or if you have responsibility in the administration of a plan as opposed to the disposal of the assets of the plan specifically. So under these guidelines, surely the retirement board is a fiduciary for the plan. Right? Okay, that's no big surprise to all of us, right? But if we move ahead to page 5, we can clear out, okay, what are the responsibilities you have for being a fiduciary? There are 4 big ones. You have duty of loyalty, duty of care, duty to diversify plan assets, and a duty to act consistent with the documents which govern your plan. So those are the 4 big things that you generally have to follow if you are a fiduciary. So the duty of loyalty really talks about not having conflicts of interest and acting solely for the purpose of the beneficiaries. As a fiduciary, all the things you do on this board, you should be acting solely in the interest of the beneficiaries at the end of the day, and not for yourself or any other purpose outside. Duty of care, this means that you should act in a prudent manner and act as a person with your responsibility as they should act, being a prudent expert, if you will. You should be knowledgeable of the requirements you have, and you should act with prudence with those responsibilities. Diversifying plan assets. So this is to make sure that you don't put all your eggs in one basket. And as you know, you have a well-diversified portfolio from an asset class perspective as well as individual manager level and individual security perspective. And then you have a duty to act in a manner consistent with the documents governing the plan. So with that, you really look to the investment policy statement specifically for the way it governs how you manage the investments within the program. Okay? Let's flip ahead to page 7. And so we're often asked, well, how do I make sure I'm meeting my fiduciary responsibilities? It's a big responsibility you all have, and in some situations it's a personal liability that you take on when you are a fiduciary. So what are the few steps you should do, and we outline 6 here? You should prepare and periodically review written investment policies, so you're doing that, right? when you review your investment policy statement. Diversify portfolio assets and with their specific risk and return objectives of the plan. And so you do that every 3 to 5 years. There's an asset allocation study, and we're going to be helping you do that going forward. Use qualified investment managers to make investment decisions. Makes sense, right? So you're delegating the individual security selection to the managers that you have in the portfolio. Control and account for fees and expenses. So that's something that you need to take a look at, and periodically we look at the fees associated with all of your investments in your funds to make sure that there are no lower cost options out there. Monitoring the investment managers is step 5, and then step 6 is document the process used to come up with your investment decisions. And this is a big one right here. A lot of times when, and I defer to all of our legal counsel here, but a lot of the times when there's a question about the outcome of an investment decision, where it comes down to is, what was the process you took to make that decision, and do you have documentation supporting that, as opposed to whether or not it was the right or the wrong decision at the end of the day. In investing, we're always dealing with uncertainties. We don't know if the stock market is going to go up or down tomorrow, when it's going to stop going down. We know that we don't know that. But what's important for all of us to do is to make sure that we thoroughly document the process we took to come up with the investment decisions we made, so that if there's ever a question about the outcome, we can turn back to look at the documentation of the process. And that's the thing that really is most important as a fiduciary. Okay, so with that, unless there are questions, we'll flip ahead to capital market theory.
Greg, I had a question.
Yeah.
I was talking with James Wilbanks about JPAs, Joint Powers Authority, and if a smaller system decides to pool assets with a larger system, to what extent, and the larger system has a different asset allocation system, to what extent do the fiduciaries of the smaller system have to discharge their responsibility?
Well, from my point of view, would be that you would have to do a due diligence on that other investment you're going into and hold it to the same standard that you hold an outside investment. Right? So you, from my point of view, and others might have a good reason to disagree with it, I think you would have to look at that as just any other outside investment and make sure it fits what's important for you and meets your fiduciary responsibilities.
And is that decision driven all by metrics, their performance over time in both bull and bear markets on a risk-adjusted Sharpe ratio basis? Is that enough of an examination?
Well, you certainly want to look at quantitative factors when you are evaluating any third-party asset manager. What's their performance been in the past, and does that meet would have that met our expectations in the past? But you also want to look at other things like who are the people managing the portfolio? How long have they been there? Is there continuity with that team? What's their incentive to stay? How do they build a portfolio, and do I agree with that? Do they have a similar investment philosophy as I do? So you would also want to look at a lot of other qualitative factors, not just do they have good numbers.
Thank you.
Yep. Okay, so we're going to talk about capital market theory, and this stuff can be a little academic. So why do we go over it? Well, there's actual real practical implementation for you when you are building a portfolio and monitoring the portfolio. So capital market theory is a theory that tries to explain how investors put together portfolios and how they have a trade-off between the risk and return offered by an individual security or individual portfolio. So you use this information for coming up with ways to put together portfolios, how to value individual assets, and to measure the performance of the portfolio going forward. So after we go over this section here, hopefully it'll help you understand some of the language we use when we talk about putting together portfolios or asset allocation work, but also how we measure the performance of an individual manager or your composites over the long run. We often throw around language like alpha and beta and residual risk tracking or correlation. Those are all words that we use to describe reality. And all these words are based on some sort of academic theory. So we're going to walk through it and share some of that academic theory for you so that you kind of understand what do we mean when we say that's a high beta manager, a low beta manager, or your domestic equity portfolio tends to be high beta, which we've talked about that in the past. Okay. So first, let's define something called modern portfolio theory. Modern portfolio theory is a theory on how investors balance risk and return. And there are a few important assumptions within it. One of the big ones is that when you're talking about a return of a security or a portfolio, you're really talking about the return of its totally it provides to you. So it's capital appreciation and income. So we combine those two to look at a total return framework because you can always choose to make your own dividend, if you will, by selling an appreciated security. So it's a total combination of income, realized gains, and unrealized gains. Another big assumption with it is that it assumes that returns are normally distributed. So how many of you took statistics ever? Yeah, boy, it's been a long time ago, right? It was probably painful. But a normal distribution is an explanation about how a population of something should act. And if something is normally distributed, you can explain how these things act by a few numbers. Return, standard deviation in particular. And it really comes down to this thing called the bell curve. So if you look at the page in front of you on page 10, you see this pretty chart of, it kind of looks like a bell upside down. And in this bell, it's used to describe, okay, how can we characterize the patterns of returns for some asset class or some individual portfolio. In this example here, we're looking at something that has an expected return of 10%. So you see that the peak of that bell is right at that 10% line. Return is measured left to right, so it's right at 10%. And you see the highest probability of what the return this is going to generate is 10%. But we recognize that there's uncertainty about how often it is going to return 10%. It might be 10% just 5% of the time, and the rest of the time it might be 24% or down 4 percentage points. That uncertainty is described by standard deviation. Okay? That standard deviation describes how wide this distribution might be, and it really conveys, well, how confident am I that this return is actually going to be 10% over the long run. So those are a couple big assumptions in modern portfolio theory. On page 11, we document out this standard deviation and expected return and then the distribution a little bit more. So here on the page, you'll see that the yellow line here in the middle is the expected return of 8%. And we say, well, I think it's going to be 8% over the long run, but about 2/3 of the time, I think it's going to be plus or minus 18%. So the majority of the bell curve, 2/3 of the time, is plus or minus 18% relative to that 8. So it might be, if you take the expected 8 and you go down minus 18, that's a -1 standard deviation event. Your actual return is -10. If you go up 18% from the expected return of 8, the return is -26. So in this situation, the standard deviation of this distribution is plus or minus 18%. This is very similar to what the broad stock market, we believe, should provide over the long term. We think in any given year, you should expect about an 8% return, but in any given year, it'll be plus or minus 18% of that 2/3 of the time. So not a lot of, we think that over the long run, it's going to be 8, but any given year, there's tremendous volatility around that. And yeah.
So I've heard 8% historically, but do you still think that's true? I mean, I've read some analysis that there's lots of baby boomers who are in the sell mode now, not the buy mode, and just the demographic changes. Also with interest rates being almost non-existent, there's less ability for government to kind of stimulate the economy through, or the banks to stimulate the economy through lowering interest rates. So do they really still think it's going to be 8% going forward? I mean, I know we're talking long term, but still.
Yeah, so our long-term expectation for stocks is going to be about 7.5% in a geometric framework. And the standard deviation is about 18. So this is rounded just to make kind of simple numbers. But we do think in the long run, 7.5%, it makes a little more sense.
Greg, would you define that long run for us?
Yeah, so that's 5 to 10 years. And there are tremendous headwinds our 7.5% return with this is lower than what we would have predicted 10, 15 years ago. So, but we think you don't have to go through heroic measures to come up with 7.5%. Importantly, that 7.5% return is a nominal return, including the impact of inflation. And we think that over 10 years, if you average 2.5% inflation, if your dividend yield is 2 or 2.5%, and if your nominal GDP growth rate is 2 to 2.5%, you add all of those up and you come up with about 7.5%. On top of that, you have a share buyback of corporations buying their own stock back, and that could definitely get you up into that 7.5% return over a 10-year time period. Now, when I was very young, I remember that people used to predict the stock market would be 12 to 15% per year, and this is obviously much lower than that growth.
Greg, what models do you use to forecast the probability of something like the Japanese stock market, where you have 20 years of stagflation and flat or even slightly negative trending returns? I mean, it's not exactly a black swan event because it's not one event, it's 20 years. And they're just locked in that market and seem to be trapped. How do you by what calculus do you try to forecast that?
Well, so we have broad expectations for global growth and U.S. growth. And we want to make sure that those forecasts are consistent with our return expectations for stocks and bonds. We certainly look at tail events and how they could impact the return of a given asset class. And those tail events are the things that really make this standard deviation wide. Right? So if you recognize that something bad might happen in the world, you have a wider standard deviation. It means your projection of that return is less certain over any given time period, and standard deviation should be wider to incorporate that. So that's how we practically put it into these assumptions. Another thing we could do is model individual scenarios that might say, okay, what if the United States goes into a deflationary cycle, like Japan has had? What would returns look like if that did happen? That would be just, if we ran a Monte Carlo simulation with 2,000 scenarios, that might be only 15 or 20 of those scenarios. But we have specific return streams associated with that possibility. It's certainly not our base case outlook, but it is captured in the tails of these distributions. Okay. But here, to me, one of the big things you're bringing up is that we can say that we expect something to return 8%, but we all recognize that there's uncertainty around that projection, and you as investors have to be able to accept the expected return, but also the best case and worst case returns as well. And you need some sort of, if we do have a low probability of that happening, you need a way to manage your portfolio and your total investment program to take that into effect.
So that being said, in the past, you've basically, I think, estimated that our allocation would be like a 6.6. Can you just explain the difference there? Just because, I mean, so you're saying we need to change our asset allocation and we could be at this point? Is that?
So we have some of these charts later, and in fact, on page 42, we'll be getting to this, but right now, if you run your expected return, our 10-year geometric expected return for your current asset allocation is about 6.6%.
Right.
And that's going to be a little bit lower than it was last year, just a little bit. But it's certainly lower than it was 10 years ago, if we were to bring those numbers for you. Yeah, so these are geometric returns. So
that's the difference, is the way that you're calculating the returns.
Yeah, but your 1-year expected return is 7.25%, and that's the number that's more akin to what I think your actuary uses, right? But we also show you this geometric return of 6 and 6.58. Did that answer your question? Sure.
Sort of.
Do you want me to follow?
Yeah. No, I just based on what you had just said before that, there was kind of a disconnect there for me as to, because you were just saying say what you said before. You said I think you said your 5 to 10 year rate.
Yeah.
You thought was closer to 7.5%, 8%.
Yeah, and that's for the broad U.S. stock market.
So that's for everything.
That's for stocks only. U.S. stocks.
Okay, gotcha. Okay, so that's the difference. That's for stocks. Okay.
Right.
Okay.
And then when we look
explains
at your portfolio, we look at.
Right, because we've got the fixed income, we've got real estate, we've got all that. Okay.
Yeah.
So the broad stock market is that.
Exactly.
If we were 100% in the stock market, but because we have this diversified portfolio with fixed income and real estate, that's why we're 6.6.
Indeed. And the volatility of your returns aren't 18. Right? So if you were 100% stocks, your expected return would be higher.
Okay.
But your volatility would be, your standard deviation would be 18. So in any 1 year, you might be 26% or down, 10 to 28%. And your standard deviation is about 13. It's still high. There's still a lot of uncertainty around it, and certainly volatility in any given calendar year. Excuse me.
I'm sorry, what I had to do with before the market closed, and so I'm sorry, I had to excuse myself. But so, which of these mixes relates to the last study you did for us that turned out 6.7 for a 10-year number?
We're not showing that here, Ed, but on page 42, we're showing
which is our asset mix now?
Target. It's called Target.
Okay.
And so using our updated capital market expectations.
So the 10-year number on our target, which is what our present allocation is, is a geometric 6.58% return before administration expenses and before investment expenses. Did I say that correctly?
Yes. Okay. So going back to page 11, we try to hit a couple of concepts. Expected return is your expectation, but taking in uncertainty into consideration, you have this other term, standard deviation. It describes how certain are you that expected return and how wide the distribution might be. And then there's been a lot of critique of the world saying, well, markets actually aren't normally distributed. Remember that big one of those assumptions we talked about in a couple slides before? Well, let's look at the calendar year returns on page 12 of the U.S. stock market over time. And lo and behold, it actually is pretty darn close to normally distributed. It actually looks that way. But what drives people's critique that it's not normally distributed is that you do actually experience those really bad events. Normal distribution doesn't mean that you're never going to have a bad event. In fact, it says you are going to have bad events. So what this chart shows is that for the U.S. stock market, any calendar year return is logged for the last 227 years here. And if you kind of back up and you just look at the chart, yeah, that kind of has a similar pattern to that bell-shaped curve. It certainly does. But let's look at 2008, where you're deep in the left end of that return distribution, and we posted a negative 37% return. And there are only 5 years, over 227 years, where we had a return that bad or worse than that. So it was a real tail event. It is not a normal event for us for the stock market to be down 37%. And ever since then, you see that we've actually clipped off a positive return for the stock market, in some cases just barely, for every year since that time. So if you actually stuck to your long-term policy target and you weathered through 2008, you would be farther ahead today if you stuck to your guns. Now, in the middle of 2008, if you opened your eyes and said, oh my goodness, I can't stomach this risk, I didn't realize there was this much volatility, and you know what, I can't stomach it. If you would have sold at that time, you would have not have rebounded. You wouldn't have come back. So what's really important is that you actually identify your true risk tolerance and know that I can stick with this through really bad times. Because if you capitulate in the middle of the down market, you'll never make it back. Another key aspect about modern portfolio theory is that there's a relationship between risk and return. And this assumption says that, okay, if something is riskier, it must offer a higher return to compensate you for accepting that risk. So on this chart, we look at expected return up and down, and the standard deviation or volatility of those returns left to right. And you'll see that we're plotting expected returns and standard deviations for different asset classes. You'll see that there is a general relationship from our point of view about how volatile something is and how much return you should get back from that asset class. Now, there are a few asset classes here that fall well off that line. Commodities, for example, have a lot of volatility and shouldn't produce real positive return for you over a very long time period. And then some of the fixed income sectors, because of extremely low yield at this point, and especially when you take currency into consideration. But with those exceptions, there's generally a relationship that risk and return are intertwined with each other over the long run. So risk and return are a couple of characteristics that you use to describe an asset class. And there's another important one, and in many ways is equally important to the other two, and that's something called correlation. Correlation describes how two asset classes rhyme with each other throughout the market. So if you took two stocks and let's say two automotive stocks, you would expect them to move up and down very similarly to each other. But let's say you've got Ford Motor Company and then you compare it to a German healthcare company. Should they move up and down the same way as each other? Not as much. Okay, let's say you've got Ford Motor Company and then U.S. Treasuries, secured bonds. Should they move up and down together? No, not so much at all. So this relationship we're trying to quantify here is something called correlation. And correlation runs between +1 and -1. If it's +1, they move up and down perfect lockstep. If it's -1, they move perfectly opposite. They're mirror images of each other. And why is correlation important? It's because if you put together, it's mathematical proof, if you put together two securities with the same return expectations, same volatility expectation, but a less than 1 correlation, you put them together, your portfolio will have a lower standard deviation than the two pieces. You'll be taking on less risk than the two individual pieces if their correlation isn't 1. And we have this chart here that kind of explains that. So here with the blue and yellow dotted lines, you'll see that the height of them is the same, standard deviation of them is the same. The expected return of 8 is the same, but if you add yellow and blue together, you actually get that red line. And you see with that red line, they have the same expected return of 8, but the height of the sine curve there is lower, so it's a lower standard deviation. That's the power of diversification. It's the one, arguably the one free lunch in investing. One important thing about diversification, though, is you have to look at it over a long term. And we're having a lot of investors struggle with that right now because the combination of assets that has performed the best over the last 5 years, U.S. stocks and U.S. bonds. If you were just 100% in U.S. stocks and U.S. bonds, you would have had the best performing portfolio out there for the last 5 years. If you had anything international, it would have done worse. Those international portfolios bring in diversification, but over this short time period, they certainly drag down returns. So a lot of the work that goes into projects like this, so you have to keep in mind, it's looking at a very long time horizon. It's looking at 10 years. It's not necessarily looking at the last 5, where diversifying into international assets, for example, certainly hasn't produced a chart like this.
Greg, when you're talking about volatility, I wonder if you can explain something for me. When we had our June 30, 2015 report that you prepared for us, we had a 10-year return on our target portfolio of 7.42%. In the next quarter you did, that 10-year rate of return went from 7.42 to the average return of 6.28. That surprises me in the volatility of a 10-year return in one quarter. Can you speak to that, for whether we should be shocked by that kind of volatility or not on the 10-year number?
So this is 10 years ended
10 years ended June 30th,
15.
15, and 10 years ended September 30th, 2015. Both reports that you prepared for us in these kind of books that you prepare for us on a quarterly basis, you're going to do next month for the year end.
Right.
And it's a 10-year number where you compare what our portfolio has done to the benchmark, or to the total fund benchmark.
Okay.
And you show a last quarter, last year, 2 last years, last 3 years, last 5 years, last 7 years, and last 10 years. What surprised me is the volatility from 7.5 basically in June to 6.25.
Yep.
About 1.25% if I'm rounding to the nearest percent.
Yep.
in a 10-year average rate of return number?
That's a huge gap. I'm a little surprised by the magnitude of that. And I trust our numbers are correct in that.
Will you speak to that when you speak to us next month?
Yeah, I will. So there are two things going on. One, you're adding a new quarter,
And you're dropping one off.
and you're dropping one off. And over a 10-year time period, if the one you're adding and the one you're dropping off, if the difference between those is a 10% difference,
You'll have a percent.
then you have a percent.
And you have compounding in there too. But
Exactly.
still, the magnitude of it shocked me.
Yeah. So if your total portfolio was up 5 in the one you added, and it was down 5 in the one you dropped off, that's your 1% difference right there. It's, thinking about it that way, it's not shocking that you had a 1% difference.
About a 1 1/4, about
Yeah.
100, almost 120 basis.
Right. Because if your portfolio is up or down 5% in a quarter, I'm not
I
shocked.
think we were down 6% in that quarter.
Okay,
And that shows that quarter. I can't go back and see the quarter.
right. And we had that. It's buried in the numbers. We have that. But that's what's going on. One thing you could come up with the average 10-year return over the last 15 years or something like that to kind of come up with a smooth number. But yeah, that really speaks to how important volatility is. We're not surprised if you're up or down 5%. Yeah, it could certainly have that impact. And your portfolio volatility would be projected to be about 13. So we expect that 6.5% return plus or minus 13. So yeah, 5% quarters. It isn't a big
We
quarter.
expect that on an annual basis.
Yeah.
I was going to say, looking back at the chart on page 12, 2005, which would have been the quarter that dropped off, is still in the 0 to 10% plus range, so it wasn't one of these anomalies way off the chart.
Yeah, but it could have been any individual quarter.
That quarter,
within
right.
Yeah, within that annual. So correlation is another real important number here, and it describes how asset classes interact with each other. And if you take return, risk, and correlation, a smart guy named Perry Markowitz came up with a paper that said, and he got a Nobel Prize for it, he said, okay, we can use these numbers to come up with what he called efficient portfolios using a quantitative tool. Using these quantitative tools, he said that a rational investor can build a portfolio over time that maximizes return per unit of risk or minimizes risk per unit of return. And it's stated that all investors should act this way, maximize return per unit of risk. And if you take all the asset classes in the world, return, risk, standard deviation, put them together, and you use this mathematical tool, you can come up with something called an efficient frontier. And that efficient frontier on page 18 shows you the combination the best return per unit of risk, the lowest risk per unit of return, based on all of these inputs we have, return, risks, correlation. What's important to note is that those inputs drive the shape of the curve. If the inputs are wrong, the curve's wrong, right? But still, this is a useful tool to come up with that shows, okay, if this is our view of the world with risk, return, and correlation, what's the most efficient mix of all these asset classes? And we have this blue line here representing it. So this is an efficient frontier. There's no portfolio you can make that has more return per unit of risk or less risk per unit of return than those that are on this blue line here. Okay? So when you build a portfolio, you want to make sure that you're plotting on the efficient frontier. Otherwise, it implies that there's something out there that's more efficient. Okay. Now, let's flip ahead to 20. And the problem with Markowitz's model,
Can I ask you a quick question?
yeah,
So once you identify your efficient frontier and the sweet spot on your efficient frontier, can you, and say you're not there, can you identify what missing piece, what piece you need to get at that sweet spot?
yeah. So if your portfolio is allocated differently from the efficient frontier, let's say where point A is, you can say, okay, what asset mix would give me this higher return for the same amount of volatility? That would be, well, what does portfolio C look like?
Right.
And you can look at the asset mix, so it's 30% bonds and 70% stocks or whatever it is. Or you could ask the question, well, if I'm happy with this return, what portfolio has a whole lot less risk? And that would be portfolio B. And then you would look at portfolio B and say, oh, what's the asset mix for them? 30% bonds, 70% stocks.
And does this take into account alternatives, or is that just a whole other discussion?
Well, so we have, we have return and risk assumptions for public market and private market asset classes. So if you had hedge funds or private equity, you could put them in the model here, and the efficient frontier would reflect the inclusion of those asset classes.
Thank you.
So on page 20, the problem with this method, though, is that if you had a 1,000 stock portfolio, which the Russell 3000 index has 3,000 stocks, you would need about 500,000 covariance matrix to pull this off, right? I mean, it's just operationally really difficult to optimize, especially before there were computers we have today, to optimize a portfolio to come up with this efficient frontier. So this other Nobel laureate, Bill Sharp, came up with a new method to, to talk about capital markets. Instead of just return and risk, what he came up with was a method to describe the returns of a portfolio in terms of how sensitive it is to moves to the market, and does it have any alpha relative to the market. And we'll flip back to page 19 to describe that concept. And in here, what we're showing is the number of stocks in the portfolio left to right, and then the total risk or standard deviation of the portfolio up to down. So if you only had one stock in the portfolio, if you only had Apple, let's say, your volatility would be really high, right? But let's say you had 5 stocks in the portfolio. The volatility comes down quite a bit. Well, what if you had 100 stocks? Well, it comes down a lot more. What if you had the whole portfolio? Standard deviation comes down a lot. Let's say you had the whole total stock market. It comes down to a lot, but it's still not zero. You can't completely eliminate stock market risk if you diversify all the individual idiosyncratic risks of the company. So there's some non-diversifiable aspect to asset classes, and that is called systematic risk. So how much risk is there associated with just being in the market? And then how much risk is there for being just in one individual company? That's called unsystematic risk. So systematic risk, that thing is, we have a term for it, and it's beta. When we say beta, we describe the volatility of the portfolio or a group of stocks, and we say, well, how much are those stocks going to go up and down if the general market goes up or down? Okay, so that's the term beta. It's this undiversifiable systematic risk. And then there are individual risks associated with individual stocks, and they differ from the market, and That difference is what we call alpha. Okay, it's a term that we throw around a lot, but it's how you differ from a non-diversifiable's perspective with the market. And if we go to page 22, we can show how you can quantify what this alpha and beta is. And on this chart, it describes the regression of the stock's return versus the market's return. Okay? So the market return is left to right, and the stock's return is up and down. So if you run a regression, which you might remember from statistics, it says, okay, what's the relationship between these two things? If the stock market goes up a lot, does this thing go up a lot more? If it goes down, does it go up and down a lot more? So how much it goes up and down when the market goes up and down is really captured by the steepness of that line. How steep is that line? The steepness of the line is beta. The market goes up a lot. Do you go up a lot more? So that's the beta of the portfolio. Let's say the market doesn't go up or down at all. Somehow you still make money. That's alpha. Right? And that is described by the y-intercept of this regression line on this chart here. Okay? So a couple of big takeaways here is that a portfolio and a collection of stocks or individual stock can be described by regressing its returns to the market. How sensitive it is to changes in the market is alpha, and its return, regardless of the movement of the market. Did I say that backwards? How sensitive it is to change in the market is beta, and then its return, regardless of the movement of the market, is what we call alpha. Okay. So those are a couple of key concepts. We throw that terminology out a lot when we do performance measurement. So I thought we should definitely capture that. So flipping ahead to page 24, here are some common risk metrics we use when we're describing the performance of a portfolio or your portfolio. And they use terms that we've already talked about here. So from an absolute perspective, if you're worried about just what's absolute return of the portfolio, what's the absolute volatility of that return of the portfolio, you would be focused on return and standard deviation. What's the return of the portfolio? How certain are those returns of the portfolio over a given time period? Return and standard deviation. But there are other ways you can measure returns. And one way is you look at the efficiency of the returns you earned. Is this an efficient way to get my 6.5% return? And there are a couple measures that you can look at to test that relationship. One is taking return and dividing it by the standard deviation of those returns. And that is something called the Sharpe ratio. So John mentioned that earlier. The Sharpe ratio is your return divided by the volatility of those returns. So hopefully your Sharpe ratio is positive. The holy grail is having a Sharpe ratio of 1, but most asset classes don't come close to that. Most of the time they're closer to half to 3/4. You can also measure the performance of a portfolio relative to the market risk you're taking on. That's my return divided by that thing that we call beta. So that's the trainer ratio. So we have that in our performance measurement reports for you too. What is the return divided by the market risk we're taking on? We have the regression-based analysis stuff here, and so we went over alpha, beta. Residual risk is the confidence you have over your alpha projection. So alpha and residual risk are paired together just like return and risk are paired together. And you can have ratio just like the Sharpe ratio, and that's called the information ratio, which takes alpha divided by residual risk. And then we have, with any regression analysis, what you want to make sure is that the model you're using here actually explains the returns effectively. And the tool that we look at there is R-squared. What is the, how tight a fit are these relationships? Okay? All right, so that is a bunch of theory behind capital markets. I say we flip ahead and we just talk about asset allocation and how we're going to be applying that, what we just talked about in asset allocation going forward. Does that sound good? Okay. Does anyone have any questions so far? No? Okay. All right. So, why do you conduct a, oh yeah, what's up, Tim?
Just to unconfuse me, as I flipped over to page 26, it gives, I think, a different definition of alpha than you were talking about. Alpha to measure a manager's added value over the benchmark. Are these, because these are two different subject matters, that they have the same name, or am I confused?
When I was showing the example of a security's alpha relative to the market's beta, you can use the same process to describe the performance of a manager relative to the market. So if you ran that same regression line to a manager and a collection of securities they hold in their portfolio, you can come up with that same regression line that describes their portfolio based on how much market risk they're taking, beta, and whether or not they're adding returns over the market and alpha. So you can apply it to a manager's portfolio as well.
That's where I've always heard it applied.
Yeah.
That's what was confusing about when you were talking about the regression analysis.
Yeah, indeed. And when we show the performance of your managers, we show statistics that include their alpha and their beta.
Okay.
Now, I thought I was losing everyone's attention, so I wanted to move along from it. But let me digress here for a second because you brought it up. A lot of times in the industry, when people throw out the term alpha, they actually mean something slightly different. They don't mean if you run a regression on my returns and you take out the market risk I'm taking, how much money am I making for you? What they really mean is, did I beat the market or not, without the regression analysis, right? From an academic standpoint, what we're showing you here is the true definition of alpha and beta. But linguistically, a lot of people just use sloppy language and say, if I beat the market, then it must be alpha. Now, you could turn back to them and say, well, you beat the market because you were levered to the market. You didn't really beat it, you just gave me more risk. That's the point that this definition of alpha is trying to get at. Manager, you just borrowed money and bought stock futures. That's not, you didn't add value. You didn't do anything that beat the market. You just gave me greater exposure to the market. You just gave me more beta, and that's not skill. I don't want to pay for that. I don't want to pay for something to bring to the portfolio that isn't skill-based. If you just bring me a bunch of market risk, I could buy that cheap. I could go buy an index fund. Right? So when a manager comes and says they beat the market, and they use the term alpha, we actually use the term excess return. You exceeded the return of the market, so that's excess return. How consistent has your excess return been over time? If you take the standard deviation of excess returns, you come up with something called tracking error. How consistent has your excess return been? That is tracking error over time. So that's actually an important number. for you to know, because it's something that's thrown around a lot, the definition of that number. And it's the same principle as standard deviation or an expected return. If you have a manager who has beaten the market by 1% on average over 10 years, but their tracking error, the standard deviation of that excess return is 20, is that a good manager for you? So in any given calendar year, they beat it by 1% plus or minus 20. That's actually a horrible trade-off, right? What if they beat it by 1% and on average it's plus or minus 2? That's actually pretty good. That would be a pretty efficient trade-off. So 1% excess return, tracking error of 2 gives you something called a excess return ratio of 0.5, and that's a pretty darn good number. I'll teach you never to ask a question again, Tim. All right, so what's the asset allocation process and why do we conduct one? The number one reason you conduct one is the thing that determines your returns more than anything else is just what's your broad asset allocation. You can have the best managers in the world, you can have the worst managers in the world. They'll make a difference of your portfolio return by 1% or something like that. But what determines the total risk, the total return of your portfolio is really determined by asset allocation. How much money do I have in stocks and bonds? How much are in hedge funds? How much are in international versus US? Those are the big decisions that really drive the performance of the portfolio. Not so much who's the best manager in this area, right? So the big lever that you have in managing the portfolio is asset allocation. It's the most important thing you do. So coming up with asset allocation, you want to come up with that optimal portfolio, that efficient portfolio we talked about on the efficient frontier, that balances all the risks that you have out there. What does your liability look like? What are your capital market expectations? Do you have cash flow considerations? Is money coming in or is money coming out? What's your risk tolerance? Can you really stomach it down 15% return in your total portfolio? Or would that just create so much chaos that you wouldn't be able to hold the portfolio through the rebound? What's your time horizon? And what are your overall investment goals? So an asset allocation should balance all of those things. It's a complicated process because most of the time these issues are at war with each other, right? Do you need liquidity? Well, if you, liquidity is at war with expected return. Highly liquid asset classes tend to have a lower expected return than illiquid asset classes. So these are often competing objectives, and walking through an asset allocation perspective can help you balance all of these as you come up with a long-term expected return in an efficient portfolio. So a few elements that you have in coming up with when you're doing an asset allocation process includes identifying the asset classes you want to include. So the first step when we do an asset allocation process, we say, okay, what asset classes are actually on the table here? We're not going to model local currency emerging market debt if we think there's no way that you would implement it. And frankly, there's no way you would implement it because the allocation side would be so tiny. And so that's that, that little niche asset class is off the market, off of consideration for you. But where you can have more debate are things like private equity and hedge funds. Right? There are some investors who say, I would not tolerate the illiquidity and the fees associated with private equity and hedge funds. And because of that, I don't want them in the asset mix at all. I don't want them to be a component. Other investors are very comfortable with that, and they want them included in the asset allocation project. So this is one thing that we're going to have to talk about up front is, okay, what asset classes do we want to throw in the mix? Do we want to include some asset classes they haven't looked at in the past hedge funds or private equity. And we could go through the pros and cons of all of those.
Didn't we choose away last time, not because we didn't like them, but because we saw for what they delivered, they just increased our risk and didn't necessarily increase our return?
Yeah, when we included them, they didn't materially move the efficient frontier.
So it wasn't a prejudice against them, or we didn't even go beyond that. It's just they didn't deliver.
That's right. And then with private equity, with that materially changes the liquidity profile as well, because those are commitments you're making for a decade. And if you have more money going out than going in, that's not a good combination for a private equity program that you want to ramp up over time. Okay, but that's one of the key elements that we take a look at. And when we're doing an asset allocation process, we want to try to focus on big, broad asset classes. You don't want to get into the detail about, okay, do I want a value manager or a growth manager? Do I want quant or fundamental? Do I want Japan only versus European only, right? You want to talk from a bigger perspective. And from a big perspective, there are generally just a couple asset classes you can invest in. There's debt and equity. Debt is where you lend someone money and you get interest in return and your principal back at the end of the day. That's debt, they're bonds. And then there's equity, where you actually take ownership of something and you hope it provides dividends or capital appreciation over time, but you own it. So there's one relationship where you lend money, there's other relationship where you own something, where it benefits you. And then there are broad asset classes that fall out in between it. So on the ownership side, you have U.S. stocks and international stocks. And within U.S. stocks, you have things like large cap and small cap stocks, and international, you have developed and emerging stocks. So that's on the ownership side. You could also include real estate in there. If you own real estate, which you do, you have equity and ownership in an asset there. So that's equity in real estate. On the debt side, you can generally split into U.S. and international. Within the U.S., you have investment grade, below investment grade. There are other flavors as well. And then on the non-U.S. side of debt, you have emerging and developed. So these are the broad asset classes you can invest in, and it's really what everyone in the world can invest in. So naturally, there are a couple of things that we haven't talked about here that don't fall into this, and it's because there are certain strategies that choose to invest in these categories, and they're more strategies than asset classes. So that would be a hedge fund, for example. What can a hedge fund go out and buy that's not equity and debt? I don't know. But it's just their method of going out and buying it that you invest in with a hedge fund. It's not that they can invest in a different underlying set of assets, right? Is there something else out there that we don't know about that they're investing in? No, they go out and they buy stocks and bonds or private investments out there. But at the end of the day, it's either equity ownership or debt ownership. And the decision between equity and debt is the big one that moves the needle for your investment program.
Greg, isn't there a lot of other things going on in say, hedge fund, swaps and derivatives, hedging, shorting strategies that an individual investor would be able to participate?
Well, certainly an individual investor can't do it, but I think the point I was trying to make was that all a hedge fund does is goes out and they access these markets in different ways. But if you short the stock market, you're just negative equity.
Why is that?
Right? So yeah, they're just buying things in a different way, but they are still the same things that are out there for you to invest in. When we do an asset allocation project, you have to incorporate liabilities in the process. So why do you do all this work anyway? You have beneficiaries at the end of the day who are looking for their retirement paycheck, right? So knowing how those liabilities change over time is really important. Knowing whether or not the total investment program or the retirement plan is open to new investors or closed, whether they have COLAs associated with them so their benefits go up over time, or whether they're flat. These are all real important characteristics that we have to take a look at when we make sure the asset allocation is appropriate for the liabilities that you're trying to meet over the long run. Other considerations are what your actuary might use as a discount rate. Right? So they might have an expected return, and as you know, it's important for your asset portfolio to be similar in expected return as your discount rate over the long run. Otherwise, your gap is just going to widen over the long run. Okay, so why do you conduct an asset liability study? Well, the first and most important reason is that it's the cornerstone of a prudent process. And we talked about your fiduciary responsibility earlier. The number one thing you need to do is have a documented prudent process for you to meet your fiduciary responsibilities. So this is the cornerstone of that process, coming up with what is your long-term strategic asset allocation. Through the asset allocation process, we'll also establish a reasonable rate of return and risk. So we've already spent a little bit of time talking about what our numbers are for those, for your target portfolio. Another important aspect of this process, and one that I think is underappreciated, is that we model uncertainty for you. Like, we'll come out and we'll tell you that, yeah, your expected return is 6.5, but we're also going to model and show you scenarios where, well, what if it isn't 6.5? What if it's -8? Okay, and then we have to be able to live in a scenario where we expect it to be 6.5, or when it happens to be -8, or when it happens to be +14, for that matter. You have to be able to live through all those scenarios and have contingencies in case you do experience one of those scenarios. We model this uncertainty, and through the process, it's shown out there that, yeah, this is certainly a potential outcome for the portfolio. With that uncertainty, we can quantify the impact of uncertainty we have on things like funded status, spending projections, etc. Now, generally, I think I mentioned this before, our clients conduct these studies every 3 to 5 years, or if something has materially changed with your investment program. Your liabilities change, your ability to fund has changed, or if your return expectations change meaningfully. If you look at our return expectation over the years, they move at a slow rate because we're modeling long-term returns. Over 1 year to the next, our 10-year projections for stock returns don't change by a huge number. It's not going to be positive 10 one year and negative 10 the other year. So our return expectations move slowly.
What's a long term by your definition?
10 years. 10 to 15 years. I think I've shared this chart with you all in the past. When we do an asset allocation study, what you're really trying to do is combine 3 policies that you have and to make sure that they all make sense together.
Greg, as you know, we now have more retirees than we have county workers, 1,300 retirees and 1,100 county workers. With your experience with other clients, are you finding that's also the case, and how is that impacting return expectations?
Well, it certainly impacts the liquidity profile of the investment program. So if you have fewer dollars coming in, more dollars going out,
We're selling about 600 to 700 a month. We were doing about $1 million. Now, from this year to date, we're about $600 to $700 a month. what we have to liquidate out of our payroll to make benefit and administration expenses.
So your portfolio has to be liquid enough to match those calls.
We wouldn't want to subject that portfolio to the interest rate risk, that amount probably, to huge duration for a certain percent of the portfolio.
Right.
Probably, right.
Right. Or, investments that you can't just sell on any given day. Most of your portfolios, right, most of your portfolios, you can sell them and you'll have cash tomorrow. Right? But your real estate portfolio is not like that. It's only 9% of your investment program, so it's not an issue at all. But if you had a lot more in alternative investments, then which tend to not be as liquid, then you would really have to look at the cash in, cash out issue. What if we have a down equity market and you have money coming out?
Currently, we mostly have liquidity. We just don't know what we can sell at.
That's right. Yeah, absolutely. Yeah, you can sell it, but the problem with real estate is you don't know, or an asset class like that.
Our bonds and stocks, we have pretty good liquidity.
Yeah, completely, right.
We just don't know the sales price.
That's right.
So to my question on return expectations, how do those demographics impact return expectations? More retirees than more workers?
I think it would impact your asset allocation to make sure it's appropriate for that liquidity. And if you change your asset allocation, then it would change your expected return. But the fact that you have more retirees than current employees will indirectly impact your expected return if you change your asset allocation. Does that make sense?
Yes.
John? Okay. So we got 3 policies, and we want to make sure they all make sense together, right? And in the asset allocation study, most of the time the only thing you can control is actually the investment policy. What do you do with the assets while they're sitting in your care? How do you invest them while they're sitting in your care? But a lot of times the other 2 policies are the ones that really talk about your success over the long run. And that's the funding policy. How much money do you have coming into the investment program? And then your benefit policy. How much money do you have going out?
I think it's safe to say that of those 3, this association has control over 2. It doesn't have control over 3.
And sometimes we work with clients who only have control over 1. Like they can only control investments. They have no control over how much money's coming in, and they have no control over liabilities, how much money's going out. And it puts you in a tough position sometimes because you want them all to make sense together, but with investment policy, you can't fix the other 2 things. One thing that we have worried about with some of our clients, and I'm not speaking about this association in particular, is that they have been searching for return to try to fix the other 2 policies. And in our capital market expectation, our capital market line is relatively flat. So for each unit of return you pick up, you've got to take on a lot more risk to get there. So it's not a real steep slope of, if I take a little more risk, I'll get a whole lot of return. We don't view the world that way. We view the world, okay, to get another % of return, boy, you have to take on a whole lot of risk. The certainty of getting that return is not that high, right? And so some investors we worry are trying to fix funding and benefit policy by just pushing on the risk lever, and it's not the most efficient tool out there. Our CEO likes to joke that if you try to make 10% and 8% of the world, you're going to make 2%, right? So that's our one comment about the policies here. When we go through the study, we do model all of these individual policies to come up with scenarios we think could happen to you over time. So we come up with capital market expectations for the returns, and we create efficient asset mixes, and then we pair those with simulations of contribution money coming in and simulation of liabilities, money going out. And we simulate financial conditions for you, and we show you, okay, this is what the world could look like if you have this asset allocation. Nothing else changes with your other policies. And with that information, hopefully you could say, okay, can I tolerate this risk? Does this risk make sense for me? Let's flip ahead to page 38. We already spent a few minutes talking about this. One of the inputs we put in are our capital market expectations. So these are Callan capital market expectations. And we come up with them on an annual basis. In fact, we're just releasing them this week of how we think the world is going to look for the next 10 to 15 years for long-term strategic investors like you. And that is the important caveat there, that these are really designed for, these return expectations are designed for long-term investors who have a 10-plus year outlook. We are not trying to predict what's going to happen next year. Because frankly, we're honest enough to say we don't know. Right? We don't know if the market is going to be up or down next year. There are too many variables out there. But what we do think is that, okay, with reasonable studying, you can come out with a reasonable expectation for the next 10 years. And that kind of fits your time horizon anyway, right? When we come up with these expectations, we come up with the key things that Harry Markowitz said you need to come up with: return, risk, and correlation. What's expected return for each piece, the standard deviation of each piece, and how does each piece correlate with each other. A final thing we do with the capital market expectations is that we make sure that they all work well together, that they're rational. So we look at things like, well, what's our expectation for inflation? And what's the expectation for cash returns? There should be some sort of relationship between those certain things. What's fixed income versus inflation? What's stocks versus bonds, the equity risk premium? Large cap versus small cap. Is there a small cap risk premium associated with investment in smaller companies, and U.S. versus non-U.S. equities? So all of these asset classes should speak to each other. And the long-term return expectations we come up with take that into consideration. And lo and behold, on page 39, we have a brutal chart that you can look through, and you can see what all of our return expectations are and the volatility. So this is last year's expectation. I mentioned we're rolling out with this year's this week. So
rolling 10 years, is that what you're looking at?
Yeah. So this is a 10-year return expectation.
10-year rolling for those periods? No, it's just 10 years.
Yeah.
Just 10 years.
Yeah, so what we're saying is our best guess is that if you close your eyes and open them up 10 years from now, U.S. stocks would return about 7.5% over that 10-year time period. But in any one given year, 2/3 of the time, they would be plus or minus 18% of that. Okay, so a lot of volatility in there too, which is not great.
So when you spoke earlier on page 42 of our target portfolio, and you use it here too, the 1 year and 10 year, what else is different when you look at the 1 year expected return, and I noticed that when I was out making my call, the 10 year, I know the 10 year is a geometric return. Is the 1 year there arithmetic?
It's essentially a 1 year arithmetic return, right?
So is that the only difference?
It's the same numbers generating the same return. So the reason a 1 year average return goes down over time is you have volatility, and it's volatility drag.
I've done my best to explain to this board the difference of geometric rate of return. We run into Siegel wants to possibly use arithmetic rate of return. So hopefully we understand that.
Yeah, yeah. So, yeah, there's this thing called volatility drag where, you know, any one time period it might be 7.6, but if you're down, if you have a meaningful negative return, then you have to make up a lot more to get back to that.
You don't start at zero, you start down.
Right. Right. So there is a difference between these. And we're showing both the arithmetic and geometric return for each of the asset classes on page 39.
Greg, why would the private equity standard deviation of private equity be so high, higher than, say, 4 times higher than hedge funds and even higher than emerging markets?
That reflects a couple of things. One is that if you go into a single private equity strategy, there's tremendous implementation risk. There is no market you can invest in for private equity. You can't just go out, I want to buy private equity. You have to pick an individual partnership to go into. And the distribution of returns across partnerships is huge. Some win big and some lose everything. So that standard deviation number reflects the actual implementation of the private equity return program there.
Does it reflect at all that the low-hanging fruit is on in private equity?
So we still have a return premium for private equity. So you have 850 versus 750 for stocks. So we show a return premium, but it's not huge, it's 1%. But there are a few different broad flavors of private equity. There's venture capital, there's buyout, there's special situations. And what you'll find is that if you invested in venture capital, the best venture capital managers have actually done quite well. The average venture capital manager has not. So there are big time winners and losers in this asset category. So implementation is really, really important.
Thank you.
And as you pointed out, John, there are a lot of different asset categories here that we can model. So right now, your investment program invests in real estate, public debt, public equity. And there are other asset classes that you can consider, and we did take a look at what Ted mentioned earlier. Depending on how much you put in the portfolio, they may not be the efficient frontiers for that. And on page 40, we have that correlation matrix. Remember how important we said that was before? And you see here that there are relatively few asset classes that have a negative correlation. That's something you would love to see, but there's really not a lot out there. So what you're really looking for is something with a low correlation, a low positive correlation to what you have. It's hard to get a truly negative correlation. Okay, so if you take these inputs and use a tool that combines the asset classes, you can come up with expected return and risk. And if you flip ahead to page 43, you see a picture of this. So this is that efficient frontier we talked about earlier, where there are, using our expectations, there are no portfolios more efficient than the green line I'm showing there. And you see that you are on that line, when you're between asset mixes 3 and 4, your current target is, but you're landing on the line, which is good. So you have an efficient portfolio for the asset classes that you are considering. On back to page 42, we actually show what those asset mixes are. So I talked about this before. So your current target is the first column here, target. So that's your target asset allocation. That's your current policy for making your investment policies that we came up with years ago when we did your last asset allocation work. And then we have these other mixes that are efficient. One thing to point out is look at the difference between mix 1 and mix 5. So the return difference between these two is 2% per year. Which is a lot of money over 10 years. That's compounds. That's real money out there. But look at the change in the standard deviation. You go to something from standard deviation of 9 to something from standard deviation of 10. So your standard deviation goes up by about 50%. When your expected return goes up about 30%. So it's a big trade-off. It's a big trade-off. They're taking on a lot more risk meaningfully than that return. And then how about we wrap up on page 45? And here, so important disclosure here, this is not your portfolio, right? This is just shown here to give you an example of the output that we're going to show you. And what it looks at is the funded status of the plan over the next 10 years. And it shows the range of potential funded status scenarios if the only lever you move is asset allocation. So moving from that asset mix 1 to asset mix 5, it shows you what are the different scenarios of funded status over this time period. Again, this is not Mendocino. So don't look at the numbers and take anything away from that. But what is a takeaway is how would I evaluate this if it were my portfolio? So one is that the size of the bars, how big are they? That really reflects how certain am I of an outcome, of an investment outcome. If it's a really tall bar, it means there's a lot of volatility that we're taking out. And the certainty of what the investment program is going to look like 10 years from now is greater than the bars. Another way to look at the same information is to look at, okay, what's my expected funded status at the 50th percentile? And then what's the funded status if we have a really bad equity market and we're in a 2 standard deviation event? What's the funded status difference? So it could be, if you take on a lot of risk, the funded status difference might be up to 40 percentage points. If you take on little risk, the funded status difference might be 20 basis points. 20 percentage points. So what's important to point out there is that there's no way you can get rid of the market risk. A conservative portfolio, you're still going to have downside risk of 20%.
How you doing, Gary?
However, you need to make sure that 20% live with for that 40% is something that. Okay. So hopefully that is a useful discussion about being a fiduciary, what capital market theory is, then how we can apply those things and walk the asset allocation study over the next several months. Maybe I can answer any questions you all might have.
Tim's top 5.
I remember the last time you asked. Like 4 minutes.